Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. Two Boeing 737 MAX aircraft bearing the logo of Akasa Air took off from the runways of Mumbai and Ahmedabad airports on Sunday, hotting up competition in the Indian sky. Apart from keeping the fares low, what other strategy the Rakesh Jhunjhunwala backed budget carrier is adopting to stay afloat? Let's find out.
India's newest airline, Akasa Air, backed by billionaire investor Rakesh Jhunjhunwala, began commercial operations on Sunday with the first flight on the Mumbai-Ahmedabad route. The low-cost carrier started operating 28 weekly flights between Mumbai and Ahmedabad. While Akasa has a total of 72 Boeing planes on order, it initially started operations with two fuel-efficient 737 MAX aircraft. Akasa competes directly with other budget carriers like Indigo, SpiceJet and Go First. But its network strategy will be to connect metro cities with smaller towns across India. More locations will be added in a phased manner as the airline plans to deploy two planes each month in the first year. In an interview with Nykaa Asia in June, Akasa's co-founder and CEO Vinay Dubey said it does not make sense for the airline to become another player in the busier routes which already see cutthroat competition. Akasa will still have limited metro-to-metro flying.
From a strategic perspective, I think Akasa's roadmap to look at tier 2 and tier 3 destinations makes a lot of sense because those are opportunities where the yields obviously are far better in addition to your focused connectivity into larger tier 1 cities. So you're going to be dispersing and creating better connectivity. From a revenue perspective, it works great because right now the focus is mostly tier 2, tier 3 and tier 4 coming up to tier 1. And we've seen that quite successfully work with quite a few airlines, including the success of Star Air as well as Indigo. So from a longer perspective, it works great, but at some point they will have to really migrate and come over to the Delhi Bombays of the world.
Experts also say that Akasa's strategy to focus on smaller tier 2 and tier 3 cities has more to do with non-availability of slots at peak timings to bigger cities. Hence, it is convenient for a new entrant to focus on departures from a metro to a relatively smaller city where there is no paucity of slots. On the Mumbai-Ahmedabad route, Akasa is pricing its tickets on par with other low-cost airlines like Indigo and Go First. On 12th of August, Akasa plans to start its Kochi-Bengaluru operations. On 19th of August, it will launch flights connecting Mumbai and Bengaluru. Its fares are among the lowest in both these sectors. Till recently, the cheapest fares in these sectors were dominated by Indigo or on occasion by AirAsia India. While Akasa is matching other budget airlines on pricing, it continues to rely on pricey add-ons like extra luggage fee, cancellation fee, and pre-ordered meals to generate additional money. Other services, including seat selection and priority boarding, have been priced to match Indigo and other low-cost carriers. While the entry of Akasa Air and the relaunch of Jet Airways is expected to intensify the competition for Indian carriers, ratings agency ICRA said cost headwinds from fuel costs and depreciation of the rupee will result in an increase in airfares. However, it will be limited by the intense competition and endeavor of airlines to maintain and/or expand their market shares. According to the ICRA note, the near-term revenue growth will be supported by passenger traffic growth. Domestic air travel has made a sharp recovery this year. with airlines flying over 57 million passengers in the first half, up 238% from last year.
I don't think Akasa should toe the line of getting into an aggressive price war. I think Akasa should focus on providing a good service, providing the traveler a good, reliable air transport system. Right now, we're talking about Akasa having effectively two aircraft versus an Indigo with 300. And then you start adding a Go Air and an Air India. So the competition can very easily, wipe out Akasa in the first month if Akasa chooses to go aggressive with a price war.
As experts say, it would be prudent for Akasa to focus on reliable, safe air transport and gain the trust of consumers instead of getting into pricing wars with competitors. Also, the impact of Akasa's entry on airfares is likely to be minimal and negligible, at least in the near term.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Rakesh Jhunjhunwala celebrated the launch of Akasa Airline with a huge chocolate cake. But liquor was missing. The ace investor had a few years ago told Business Standard that he was cutting down on his drinking. But not everyone is doing that. In Delhi, people are finding it hard to fetch their favorite brand due to sparse vents. A slugfest is going on the Delhi government's liquor policy. Our next report tells why.
Ushered in on November 16, 2021, Delhi's new liquor policy had promised sea change in not just the way we purchase liquor, but also in the way it was being sold. It drew curtains on the government-owned liquor vents as the entire business went to private players. For consumers, it meant a pleasant change. The days of braving rough Delhi weather in long queues were over. Grilled shops gave way to swanky air-conditioned stores where you could walk in, browse, and select the brand of your choice. And some of the vents, called super premium, even offered you to taste the liquor before paying for it. And for the Aam Aadmi Party government, which rode to power on the anti-corruption theme, the excise policy was a tool to stamp out liquor mafia, black marketing, and increase revenue. It had envisaged 849 spacious and air-conditioned liquor vents equitably distributed across 32 zones in the city. Each zone was meant to have 27 liquor shops, all of which would belong to one retail licensee. In the old excise policy regime, 4 government corporations ran 475 liquor stores out of a total 864 in Delhi. The rest were run by 389 private individuals. On the face of it, Delhi's excise policy appeared very promising. The government earned about 8,917 crore rupees through bidding against a reserve price of 7,041 crore rupees. But it was withdrawn within 8 months of being rolled out amid allegations of corruption and favoritism in license granting. The rollout was not smooth as thought. Only a handful of shops were able to operate on the first day. Later, around 644 liquor vents could open before retailers started surrendering licenses as business became unviable. By July 31st, when retail licenses expired after the government decided to revert to the old excise regime, 468 outlets were functioning. As the Delhi government allowed stores to sell below MRP to promote healthy competition, deep discounting by bigger retailers made the business challenging for others. By June, 90% of the liquor in the market was reportedly selling at nearly 50% discount. Only those licensees who also had manufacturing and wholesale operations were able to sustain the business. Last month, the Delhi Liquor Traders Association filed a case in the Delhi High Court terming the new excise policy unconstitutional since it sought a lump sum payment of duty instead of per bottle. As allegations began surfacing about undue influence of some powerful groups in cornering the liquor licenses, the Economic Offences Wing of the Delhi Police launched a probe. The newly appointed Lieutenant Governor V.K. Saxena also ordered a CBI inquiry and suspended 11 officers of the Delhi Excise Department. Amid all this, on July 30th, Delhi's Excise Minister Manish Sisodia announced the government's decision to withdraw the new policy and revert to the old excise regime and running liquor vends through its agencies for the next 6 months from September 1st. Licenses issued for retail and wholesale liquor sales in Delhi were extended till August 31 to prevent shortage during the transition period. Currently, only 342 stores are functioning as vendors from 15 zones gave up their licenses. Sisodia, meanwhile, has blamed former Lieutenant Governor Anil Baijal. He alleged that Baijal was against opening liquor vends in unauthorized areas, which led to a loss of thousands of crores of rupees to the Delhi government and windfall gains for a few private players. The Delhi government also spoke about blockage of revenues because of orders passed by courts and acknowledged that revenue in the first quarter of FY23 was 37.5% less than the budget estimates of 2,375 crore rupees. Of this, 980 crore rupees is a refundable security deposit. Private players who ran liquor stores in the old regime have shown readiness to open stores quickly if given licenses again.
We always favor a fair and a private sort of a non-monopolistic sort of a background so that our brands can be sold and also that we can have a more fair play. That is what we always want. This policy in its preamble talked about those things. Now, we are not traders and we are not involved in that, but I think somewhere down the line, they could not sort of execute what they must have wanted to do. Now, again, from the company's point of view, we are in a mix because last year we have lost the season because of transition. So from my point of view, the message is the liquor as a subject should move out from state governments because they are constantly changing policies. And after all, it's not a joke. We invest a huge amount of money and we run very large organizations. And it can't be a flippant approach. We find it in state after state, we are having these problems because somehow the policies are not being thought through. They are focused on only optimization of revenue. Prices across the country are different. Brands across the country are different. Labels across the country are different. And I think it's a fit case of getting into GST. The inputs into alcohol business are under GST. Then we are not getting any set off.
The larger issue of policy flip-flops is a common feature throughout the country, hobbling India's 3.9 trillion rupee alcoholic beverages market that contributes to around 1.5 million jobs. A 2021 report by think tank ITR said the unpredictable nature of state excise policies with frequent and ad hoc changes creates uncertainty and adversely affects production cycles of manufacturers operating across multiple states while also preventing them from planning their investments. As the Delhi example shows, sporadic regulations have often led to decrease in or significant loss of potential revenue for state governments. Therefore, ensuring a predictable tax regime is the need of the hour for an industry that is among the top 3 sources of revenue earning across most states.
यार
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Riding high on consumer spending, new age tech companies have reported better than expected June quarter results. But analysts believe it will be a long road to recovery for their respective businesses and the stock prices. Our next report takes a dive into whether it is the right time to own these stocks.
The recently concluded June quarter of the current fiscal year may prove to be an inflection point for new age tech companies. Zomato, Nykaa, and Paytm reported sharp recovery in their respective operating metrics, suggesting the companies could be embarking on their growth journeys.
It is fair to say that most of the newly listed or new age companies appear to be working towards controlling either their aggression or building profitability in their core businesses. We note that PB Fintech's core business, which is Policy Bazaar, Paisa Bazaar, and Zomato's food ordering business are now profitable. So these companies are showcasing roadmaps to profitability, but at the same time investing in new ventures and markets, which could mask overall profitability. But at the same point in time, one can note what IndiaMart is doing. They have diluted margins to chase growth, so perhaps some compromise on the high growth, compromise on the high profitability for growth. At the same point in time, other two companies like Matrimony and Nazara, we see no change in aggression. Nazara appears to be using its balance sheet more for new acquisitions.
Among key profitability metrics, Zomato's gross order value of food delivery jumped 42% year-on-year in Q1, aided by growth in volume and average order value. The company also broke even on an adjusted EBITDA basis during the quarter. Paytm's gross merchandise value, meanwhile, more than doubled to 3 trillion rupees from 1.5 trillion rupees a year ago. Nykaa reported 47% year-on-year growth in gross merchandise value, with consolidated GMV reaching 2,490 crore rupees during the quarter. Nazara Technologies also clocked 70% jump in its consolidated revenue, with all individual business segments staying in the green. Analysts believe sustainable profitability and recovery in stock prices may be some time away. They also differ on whether it is the right time to own these stocks. UR Bhatt of Alphaniti Fintech, for instance, says, with valuation froth now trimmed, new age technology companies are here to stay. They offer a certain level of convenience to consumers, which are being appreciated. While there is space for these companies to coexist, valuations will now have to be more reasonable. Others like Amrish Baliga weigh profitability over valuations.
But the question is, should we be paying such a high premium for growth without profitability or low profitability? Nykaa's cornerstone for the IPO was, unlike others, they were profitable. Although it was low, but it was in the green. However, from an investor's perspective, we need to see that grow, not remain stagnant in single digits. So at current levels, it's still quite expensive. Zomato again has shown a decent growth in gross order value and revenue per order, has a lot of cash in the books, has hit EBITDA positive, but profitability at the net level, I think, is still some time away. However, the recent sharp correction in the stock has brought it closer to the real value I've been talking about since the IPO. The unlocking of the pre-IPO equity, I think, would create more pressure on the stock price, so could be entering a range where it's fairly valued. Paytm was a pleasant surprise, no doubt, as it saw growth with the reduction in processing costs. But the question again is, when do we see profitability? For which I think the management is now expecting an EBITDA break-even by FY24. But the key to that is consistent growth from here on.
Baliga is bullish on Zomato at lower levels, believes Nykaa is overpriced, and considers Paytm to be a dark horse if there is consistency in its earnings. Markets shall remain closed today on account of Muharram holiday.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Most of you must have already filed tax returns for your earnings, including those made from markets. The last date for filing tax return was 31st July. But what if you have missed the deadline? Watch our next episode to know the options that you still have. The income tax return filing deadline, 31st July, has passed and over 58.3 million returns were filed for the assessment year 2022-23. While initial return filing was slow, The pace picked up as the deadline approached. Record 7.2 million returns were filed on the last day. If you are one of those who did not file an income tax return before the deadline, you can still file it on or before 3 months prior to the end of the relevant assessment year. So, for the assessment year 2022-23, the last date to file the income tax return is 31st December 2022. Filing belated returns is the same as filing normal return. It's just taxpayers need to select the option filed under Section 139(4) after the due date under Part A General Information. However, the belated return filing comes at a cost. The taxpayer may have to pay a maximum penalty of 5,000 rupees for filing a belated return. If the total income is less than 5 lakh rupees, the maximum penalty levied is 1,000 rupees. If there is a tax due, the taxpayer has to pay 1% interest per month till the payment taxes. If taxpayer files beyond the belated return deadline of 31st December, the fine may go up to 10,000 rupees. Further, taxpayers cannot claim deductions if they file a belated return. Losses arising from capital gains or businesses or profession cannot be carried forward. However, the loss from housing property can be carried forward. Usually, a taxpayer's refund is calculated from the start of assessment year 1st April. But in the case of belated return, the refund will be computed from the actual date of filing a return. So, the eligible taxpayers have to forego part of the refund amount. If you are filing a belated return after 31st July, the tax department has reduced the time limit for e-verification to 30 days. Usually, for normal ITR filing, the verification deadline is 120 days. The taxpayer has to e-verify the return to consider it valid or authentic. For serial non-filers or those who don't file income tax returns at all, taxpayers may have to pay hefty fines or even an imprisonment in some cases.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
If a person's total income is below the basic exemption limit, he or she will not have to pay late filing penalty. That is all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.